Good afternoon, everyone. My name is Chris Van Dyke. I'm a partner at Cogent Law Group. We are very excited that you've joined us today. We're equally excited that we once again have Adam Crabtree as our guest speaker, co-presenting with me today on cannabis lending. We're going to be talking specifically about cannabis lending. Uh, as any of you who've been attending any of the conferences on cannabis banking, you know full well that this is a burgeoning topic. It's creating a lot of interest. I know a lot of my clients are considering it given the environment, the changing environment regarding the treatment of cannabis in Washington. And so we're going to be talking about the risks, rewards, and solutions regarding cannabis lending. And Adam and as I said, Adam and I had such a great conversation during our last webinar that we both felt compelled to have a follow-up webinar specifically on this topic. And before I talk a little bit about myself, Adam, could you give us a little bit regarding your background and some information about NCS Analytics?
Sure. Adam Krebs, I'm the CEO of NCS. We build big data platforms. We play in the high risk areas, alcohol, tobacco, smuggling, bootlegging, sales suppression, all of that kind of fun stuff. But cannabis is our largest sector. As it says up on the screen, we actively monitor about 18,000, 20,000 licenses for regulators and financial institutions. We only work for regulators and financial institutions. So yeah, depending on the week, we ingest somewhere between 80 and 100 million data points, which all run through our predictive and behavioral analytics to help our clients better understand their risk.
Yeah, that's great information. And I know that you have recently come out with a specific program, THEA, to assist financial institutions who are thinking about lending. And we'll talk a little bit more about that later. Yeah, I'll just say a few words about myself. Many folks on this call may know me already. I'm a former financial regulator. I was the attorney for the Maine Bureau of Financial Institutions for about 7 years. And during my final year there, the FinCEN guidance was on cannabis banking was issued, and we assisted some of our regulated entities who were curious about exactly what that document meant. And then I left and worked for a financial institution, a small financial institution in southern Maine, for close to 10 years. And as soon as I started there, we developed, under my guidance, we developed a cannabis banking program. We were actually one of the first in the country to start with cannabis banking. And when I was there, the BSA department was a department of half a person. That was either my lower half or my upper half, depending on which one you'd like to choose. But our program did develop exponentially because we were the only financial institution at that time in Maine willing to take on that risk. So it did gain very, very significant traction and produced very significant fee income for our financial institution. For the last 2.5 years, I've been working for Cogent Law. Many of you may know Josh Radbod. He is the founder of the PBC conference held in Washington in early September every year. Our paths crossed several years ago, and it turned out Cogent Law was looking for an attorney who knew a thing or two about cannabis banking. And so anyway, I decided to join with Cogent Law. And most of my practice focuses on consulting with banks and credit unions on cannabis banking, and that kind of falls into four specific areas. I help financial institutions who aren't in the space yet, looking to get into it, perhaps just on the depository side. I've worked with some who are in it already on the depository side, but are looking to get into it on the lending side to expand their program and to increase their revenue. I've worked with a couple of financial institutions that have very mature, well-developed cannabis banking programs, but they've kind of gotten bogged down a little bit with some inefficiencies and have looked for some assistance to guide them to make their programs more efficient, more cost-effective, but at the same time, staying in the good graces of their financial regulators. And then I've worked with a couple that have gotten into a little bit of trouble with their financial regulators on their cannabis banking program and have sought remediation. So those are kind of the four things I do. I also, kind of offer on-the-spot advice if a BSA officer needs specific guidance, say on a filing. I can usually get back to that person, within a half an hour, have a conversation with them if there's something strange that's come up. So those are the sorts of things I do. I also offer external general counsel services in Maine, which is where I'm qualified to practice law. Cogent Law, we have actually an expanding banking department right now. We've had a couple of attorneys recently join us, in addition to myself, who have banking expertise. We also work with developing markets. We do a lot of work for startup businesses. A lot of our attorneys, they have come from a big firm practice. They're very, very talented, but wanted to be able to focus solely on their clients rather than on big office politics. And so they've left to join Cogent so that they can be laser beam focused on their clients' needs. And you'll see that we're also involved with cryptocurrency, and we have a couple of attorneys, actually three now, who are involved solely with cannabis, the cannabis industry. And we're all about referrals too. We're pretty well connected. This webinar is an example of that. Adam and I have got to know each other quite well. We have a great relationship with NCS and several other firms who operate in this sphere. So though that's kind of where we come from as a firm. We offer big firm expertise at a small firm price. So just a couple of housekeeping details. Adam and I anticipate that our discussion is going to go on for about 45 minutes or so. And then we'd like to leave 15 minutes for a Q&A, and there's a Q&A button there. So please feel free to include your questions there. Adam and I, if the spirit moves us, we may be inclined to answer those questions during our discussion. We'll see how that goes. But again, we want to thank the audience here for attending. These webinars are so important because of the rapidly evolving landscape with the cannabis industry and with the cannabis banking industry. So thanks so much for that. And I think we can move on now to our next slide. Yeah, so when I was general counsel, chief risk officer, and BSA officer at my financial institution, surprisingly enough, we had a depository program for our cannabis folks. We never quite got to the lending side. It may come as a surprise to many of you that, given my roles as chief risk officer and general counsel and BSA officer, that I was actually a proponent of getting into cannabis lending. And I'm going to talk a little bit about the three major risks here of cannabis banking. And if I'd been more clever, this would have been a Venn diagram. And the by far and away the largest circle of risk here would have been the BSA and compliance risk. That is, performing the initial and ongoing due diligence, the monitoring of these businesses, the low-hanging fruit from the examiner's perspective in terms of your rolling SAR filings and all of your CTR filings, which are going to increase exponentially because these are all cash-intensive businesses. So, that by far and away is really the largest circle of risk. A lot of these, the risk, is if you're not meeting these requirements under the 2014 FinCEN guidance, is getting an unsatisfactory on your BSA rating, which can affect your management rating under your CAMELS score, which could lead to document a resolution from your financial regulators. Worse, it could lead to a cease and desist order or a consent to cease and desist order. So those are that again, that by far and away is the greatest risk. The second two risks, the reputational risk and the legal risk, I view as pretty small circles of risk, to be very honest with you. Especially now with the rescheduling order, the late April DOJ order rescheduling cannabis so that it's on a par now with codeine-coated Tylenol. I think for a long time now, especially on in the boards, the board of directors have always viewed getting into the cannabis banking space as a reputational risk. That was not our experience when we banked cannabis. Many of our customers actually were government employees, and because of our older field of membership, and we did not lose one customer because of our cannabis banking program. Last year, I was at an ACB conference on cannabis banking, and there were about 160 people at that conference, and I asked the entire audience at one point whether anyone had lost a member or a customer because of cannabis banking, and not one hand went up. So I do, I am of the view that the reputational risk associated with cannabis banking is overblown. And I'm of the view that circle of risk continues to get smaller and smaller. And then there's also the legal risk associated with cannabis banking. And again, this is going to sound strange coming from an attorney. But again, my view is that the legal risk, I can't tell you that there's absolutely no risk of being prosecuted. There are laws on the books, such as aiding and abetting in the federal commission of a federal offense, and there are potential RICO violations. And also there's again, on the books, there's a chance of being prosecuted for BSA violations. But history is on my side. I mean, there has not been one bank or credit union that has been prosecuted for banking cannabis. And I think everyone on this call is very well aware of the fact that, the policy considerations for banking cannabis are compelling. You're safely vaulting cannabis cash. You're keeping your streets around your neighborhoods safer. You are reporting. You're actually, performing, you're performing a service for enforcement agencies as well as regulators by making these filings that are required under the FinCEN guidance. So again, my view is that the legal risk associated with cannabis banking is pretty minimal. So I think we can go on to the next slide here because I don't want to get ahead of myself. So again, those are all the major risks associated with cannabis banking in general here. And again, those are the the risks, those are the major risks. Those are the risks that I think you really have to, get under your belt if you're on the depository side. These are additional risks for those financial institutions looking to get into the cannabis lending sphere. And, in a very short little while, Adam is going to talk about uh, what NCS provides in terms of very, very significantly mitigating the underwriting and collateral risk as well as the marketplace risk. And then I'm going to talk a little bit about the contractual risk. Uh, but again, while these are risks, these are additional risks associated with cannabis lending. We now have tools in place, and including NCS's THEA tool, which significantly mitigate the underwriting and marketplace risk. And it also serves so that, you don't have to hire another platform of full-time employees. You've got assistance from outside vendors such as NCS. So anyway, I think we can move on to our next slide now. So Adam, I've been waffling on and not giving you a chance to talk yet. So I think I'm gonna catch my breath here and let you take over from here.
No, I appreciate that. And I think you're right. A lot of the traditional risks for programs, that's changed a lot since we all got into it. I think some of the early reputational risks, those were much different back in 2015, 2016, but now we're kind of onto this next evolution of a lot of that, which brings us to our lending. And I think we should break up those three you laid out. So starting on our collateral, I'm a banker by trade. Please don't hold that against me. I joke that I'm a recovering banker, but when we think about cannabis lending, there isn't your traditional assets. I don't expect any lender out there, financial institution, private lender, things like that, to try and collateralize inventory or other assets that you would for a normal business. There isn't going to be, Adam's Bank and Trust dispensary liquidation co. that I'd collateralized the inventory and I'm trying to sell that off. And even with things like commercial real estate, most institutions that do lending, business lending, they're comfortable with that in concept. We've got a hard asset, we can secure against it. But if we look out there in the marketplace, one of the big things that we're seeing a lot of is there's a vast difference in the valuation when that commercial property is used for cannabis purposes versus other uses, which for anyone out there that hasn't followed along, you're going to see the term future use, which basically means, yes, they may have built out that facility with a gorgeous 10, 15, $20 million HVAC and control system and all of that. But realistically, the next tenant in there may not have a use for it. So when they're evaluating the level of collateral and the value of that collateral, it changes that pretty substantially. And so that's just kind of as a framework of some of the interesting cases when we're looking at what the issues with the collateral and the classic underwriting for this are. Is there things you wanted to add into that underwriting and collateral risk, Chris?
Yeah, so I am a proponent of using hard collateral for uh, for loans. Obviously, not plant. That's going to get you into a lot of trouble as a financial institution. You're going to want to, be fairly conservative, I think, in your valuations. Like you were saying, Adam, what I advise financial institutions getting into this space is to value any of the collateral based on non-cannabis use. Uh, and obviously, you're going to want to build in some flexibility, some wiggle room into your policies regarding this, because the last thing you want to be doing is going against your policies, because that's again very low-hanging fruit from an examiner's point of view. So I do advise on giving yourself a little bit of leeway on the valuations and the types of collateral because there are going to be extenuating circumstances when you may want to you may feel it's appropriate to take on a little bit more risk uh, with the collateral. Again, there is the reason we have these webinars is because there's nothing in writing. You're not going to find an examiner's handbook on cannabis lending, and so the rule of the road is that you need to justify your decisions. And not only do you need to justify your decisions, but you need to justify your decisions in writing so that the examiners, when they come in, they will see that, oh, yes, we've considered this exception and um, we can see the reason why you've made this exception. Either, again, as I said before, build a little bit of wiggle room into your policies and procedures and also make sure that the minutes of your board meetings are sufficiently delineated, on any cannabis lending decisions. The other thing your policies need to need to take into account are they need to spell out the clear authorities in terms of who has the decision-making ability on certain loans based on loan type and based on loan amount and based on the specific borrower. And I've seen, institutions go several ways on this. Some of them have required board approval on certain cannabis loans. That's, again, that's a risk mitigation technique so that, board members can weigh in. Uh, that obviously one of the disadvantages to seeking actual board approval is that the process then becomes a little bit more clunky. And so, but as a middle ground, I would certainly recommend making sure that your specific any loan, any cannabis loans are brought specifically to the board's attention after they're made at the next board meeting, so that the directors can see exactly what cannabis loans have been made. Your policies and procedures are also going to want to specify specific limits on your cannabis loans.
Well,
Yeah.
and the other thing, shy of the board, and I found myself in front of a few of these recently, is we're seeing a lot of lending committees where, it's not necessarily the full board, it's either a subset or the senior management and things like that. So they're kind of doing that blended approach where it has to come to the lending committee. But the underwriting side in general, I think, is one of the areas that is the most interesting. We often, and I say we, a lot joke about underwriters have that, natural want to say no. They are the bank's risk mitigation, and we can tease, but that is their job. They don't want the institution to lose money, and so um, they want to. It's not that they want to say no. They are genetically programmed to say no to loans, and so when we start getting into the cannabis side where it's out of the box, it does make it a lot harder for them to get to comfortable. And a lot of the stuff that we see holding lending back, and when we came out with FIA, is how do you make that data easier to understand and then move it not only to a contextual area that is more of the classic underwriting, which is what we want, but also increase the faith in what you're being presented. I mean, the terrible part about how a lot of media stuff works is you only hear the worst of the worst, like, oh, this data was wrong or this isn't being monitored and things like that. So I think solving for part of that underwriting of bridging the gap of something scary like cannabis lending for all the collateral stuff we were talking about with something more classic of the small business lending, the cash flow lending, the commercial real estate, So you have to try to make it more traditional while not ignoring what it is. And I think that's been part of the interesting aspect as we've been rolling this out is meeting with the various lending committees or the chief credit officers or the head of underwriting and hearing those concerns and then figuring out ways that we can kind of bridge those divides in a way that benefits both the institution and the operator. So that's been super interesting as we've been going through it.
Yeah, Adam, I'm really glad you pointed that out. And I neglected to mention that a lot of financial institutions they will have subcommittees even at the board level on to decide on lending, and that again is a good kind of a middle ground approach, so that your decision making tree doesn't get too clunky. And I the it's a high risk area. It's like restaurant. It's like lending to a restaurant. Restaurants, come and go. There's a very high fail rate there. But that's I almost view lending on the cannabis side as lending to restaurants. Uh,
Uh,
there's additional risk there. There's additional risk there, and that has to be considered. But we've got these tools now in place where you can see through these programs like Thea, you can actually see what the risks are, what they actually are, what the actual risks are in real time, and that's a significant mitigation tool.
Without a doubt. And that's been what's kind of interesting is explaining how leveraging regulatory data makes it easier to base decisions off of it. I'm not saying there's anything wrong with, client provided books and things like that, but at the same point in time, there's always that doubt. Part of my tenure in banking, I was in oil and gas, and I loved that space because I'm not even kidding. Oil and gas accountants could give the best cannabis accountants a run for their money when it comes to how they structure those returns. But there was more than one occurrence where the tax returns I was given versus the tax returns I got from the IRS, filed the 405(x)(T and all of that kind of stuff, they weren't the same. And so there is a reason that any of our lenders that are on here, we still request documents directly from the IRS. We still request those filings because yes, I trust you, but trust but verify. So being able to bring in regulatory data for cannabis in that continuous every few hours daily sort of way is enabling a greater degree of comfort in the data you're being provided as well as the granularity. It's one thing to see quarterly financials or annual financials. It's another to be able to say, hey, why is your average daily sales going down? Or tell me what's going on that we're seeing some compression in your margin. Or hey, by the way, when we approved this, your revenue was X or Y, and I'm seeing it change, frankly, positive or negative. It could be just as easily a positive change, like, hey, Chris, I gave you that $100,000 line of credit, and it looks like you're killing it now. Your sales are up, your margins up. Would another $50,000 help? So it's been super interesting to see how blending that new technology, the real-time ability to review and capture that data with something that frankly hasn't changed in a very long time of I want your financial packet. I'm going to put it in my spreading software. I'm going to do what the thing tells me to. So this has been a lot of fun to kind of push those bounds a bit.
Yeah, so right, Adam. One of the things we haven't talked a lot about is the marketplace risk, and I think this is again where your program comes in so handy. The marketplace is very enormously state by state, depending on the regulatory regime in place and also depending on the competition that's there. And what could be a huge success story for one cannabis business may be an utter failure for the same cannabis business if they're in another state or even in another county. So, Adam, do you want to talk a little bit about how your program talks, addresses that risk?
Absolutely. So the marketplaces are incredibly dynamic. As with any of any business, the marketplace is, but I would say that cannabis is incredibly reactive to those outside pressures, the regulatory changes, even the recent announcement of the Schedule 3 and all of that and how it works. And so these markets are very reactive. It makes them substantially more volatile, and they're not shielded from the traditional consumer ability to purchase and all of that. And so when we're looking at it, it's more on the stability and fluctuation of these businesses through the metrics. How are they managing those risks? How are they doing it compared to their peers? Are there suddenly new entrants that are going to pull away their customer base? Or did their competitor recently close? So now we've got a larger addressable market that we can. And how does that come into their financials? And do their financials make sense? When you're looking at a single number, as with anything, that doesn't tell you a ton. But when we start breaking it up into a bunch of different areas, how they work in concert with one another creates a really cool picture. I mean, at this point, we're analyzing 15, 17 different elements. They're all coming into a single risk score, not a credit score, a risk score. And so that 0 to 100, and how are they fluctuating from, zero being very low risk, 100 being high risk? And how are they comparing to the rest of the market? Is the rest of the market's margin overall declining? So are we beating or lagging on that market? Are we a sophisticated operator that the average per client sales have dropped from, $80 a ticket to $40 a ticket, but they've managed to stay in that 50 to 60 range. So they're actually showing all of these different interesting indicators that they are worthy of that credit risk, or they present a lower risk. And not only are they a way for that institution to potentially deepen the relationship, but they're also somebody that you want to be staying around with for the long term.
Yeah, great points. Great points, Adam. Yeah, let's move on to the next slide here. Okay, yeah, I do want to spend a few minutes talking about contractual risks. And again, this is something the regulators are looking at more and more now. I have worked with several financial institutions that have asked me to come up with, specific side agreements for their cannabis loans. It's and again, this really this is a legal risk, and what you're going to want to do as a financial institution is protect your liabilities in the event things go south, one way or another. And so, what I have recommended and what I have drafted for some of our clients is, it's what's known as the bad boy clause. And it basically gives the financial institution the ability to call the loan uh, in one of three events. If the uh, if the cannabis operator uh, fails for whatever reason to meet the financial institution's banking compliance requirements, by way of disclosures, or if they get out of kilter with with their deposits and so forth, without adequate explanation, that kind of thing. The second, uh, you know, uh, uh, reason for calling the loan in the bad boy in the side agreement would be if the cannabis operator falls out of favor with its state regulator, and the financial institution gets wind of this. It should be a very strict requirement in the loan documentation that the cannabis operator stays in full compliance with and remains licensed in good standing with its state regulator. And the other provision you're going to want is whether you're going to want to have the ability to call the loan in the event that the regulatory landscape changes such that it's no longer possible or feasible for the financial institution to carry on with the loan. Obviously that, given the trajectory, I think the chances of that happening are minimal. But again, you just want to hope for the best, but prepare for the worst. So those are the bad boy covenants that your side agreement is going to want to address. And I've already assisted several financial institutions uh, with that. So let's go
Absolutely.
on. Yeah.
No, I said absolutely.
Yeah. So I think we can move on to the next slide here.
On to the fun stuff.
Yeah. On to the fun stuff. A lot of this, may be kind of obvious to folks on this call. I'm a compliance guy. I always come at it from a risk perspective first, and I've been criticized for that. So, some folks say, "Hey, Chris, why don't you talk about the rewards first, before you get into the talking about all the naysaying and the risk?" But I do want folks on this call to know that, I am an advocate for cannabis banking. That's what it's obviously a risk management decision that boards and senior management have to make themselves. But it's really just a matter of recognizing those risks and recognizing how to mitigate those risks. And let's talk about the rewards. Uh, uh, and I'm going to talk first about deposit stability, because this is never talked about. Everyone assumes that with cannabis lending, you're just taking on more risk. That's all you're doing. You're taking on more risk. But in a certain way, you're mitigating risk. And what you're doing is you're mitigating the risk of your cannabis depositors leaving your financial institution, thereby losing customers, and more importantly, losing your deposits. So you're creating deposit stability. That's a significant mitigation that cannabis lending offers. I always advise our financial institutions that if they're going to offer lending to a CRB, that they make it a condition of their loan agreement, that CRB remains as the financial institution remains as the primary financial institution for that CRB. And then, customer member affinity and loyalty. Again, we talked about reputational risk before. My experience back when I was at my FI was that the our cannabis customers loved us because we were prepared to go out on a limb and assume the risk so that they could run their business as a business. And if you treat them well, they're going to treat you well and stay loyal to you. And the if you have a sustainable cannabis program that's been through one or two exam cycles, frankly, that's more important. That should be more important to a cannabis operator than the most competitive price. The last thing a cannabis operator wants is for your financial institution to become their last boyfriend or girlfriend. They want a stable financial partner. So again, that's another reward that you're going to benefit from on the lending side. Interest revenue goes without saying. You charge for your time and risk.
Uh-huh.
And so I heard nightmare stories from several CRBs being charged extortionate rates from private lenders. And there's a real sweet spot here for financial institutions to be able to charge a reasonable premium for the risk. And there is additional risk, adding that premium is entirely justified. There's also justification for adding that premium because there's going to be additional time involved, not only with the original underwriting, but also the ongoing monitoring to make sure that the CRV remains financially fit. And then, loan diversification. This is another area where your financial institution can diversify its loan portfolio, thereby, again, this is a diminishing some risk by way of a diversification. It's not just getting, as I mentioned a few moments ago, getting into cannabis lending isn't all about just taking on additional risk. There's another side to this as well.
Well, and so there's risk associated, and we can kind of bring that a little bit briefly back to the collateral. The hard collaterals, the CREs and things like that, those traditionally lowered risk, but I would actually argue in some places, cannabis being one of them, with the future uncertainty, it can create a higher perceived risk. I'm not saying actual, I'm saying perceived risk because you're tied to a very volatile industry for the next 5, 10 X years if you're doing a large commercial real estate deal. And so I think that's one of the areas that has kept some of them out. So when we're looking at your loan diversification and stuff like that, I think that one of the things that institutions should do when they're thinking about their programs is that diversification. What are some of these shorter term opportunities that can really have a positive impact on your customers day to day? But maybe you're not ready to be long-term married. You want to do an revolving or a operating line or loan that's out there for a year. The other thing on deposit stability that I wanted to add in there, not only does it make it sticky, and we got a question about that, which I got flashbacks to my mega bank days on that, but it also, especially if we're talking about operating loans and lines, which is where I designed Thea to start with, it allows these businesses to keep more cash in the institution because they're effectively allowed to create their own terms, their own net 50, their own net 30s, and things like that, to where it's not deposit and immediately cycle out to their vendor. So you're also allowing your clients to become more sophisticated, but those funds are staying in your institution for longer because they now have the ability to stretch that out. They've got that line of credit that can backstop them to where it's not immediate deposit and back out there. So we're increasing our deposit stability, but likely also their average balances will stay higher for longer because it isn't such a rapid churn of deposit and immediately back out, deposit and immediately back out.
That's a great point, Adam. I also just wanted to add a word about, cannabis lending from a regulatory perspective. I talked about those, those risks, those three initial risks, and the largest circle of risk being your BSA and compliance risk. From an examiner perspective, they obviously want to make sure that what you've got limits on your program, authorities are set in place, but the examiners don't do underwriting. They do not underwrite for financial institutions. They just want to make sure that you've got an underwriting program that's feasible, and that's reasonable and that can be justified. So it's not, again, it's from a regulatory perspective. Again, my view as a former regulator is that you're not taking on that much more regulatory risk if you get into cannabis lending, if you've been on the cannabis depository side already. So, Adam,
I would
anything?
agree.
Yeah,
As long
okay,
as we don't get into like the concentration risks and things
right.
like that. And then on the customer and member affinity loyalty, those are kind of intertwined with the interest rates because, as you alluded, there is a responsible interest rate. It is going to carry a premium over, a classic manufacturing business's line of credit, something like that. But at the same point in time, it's going to be substantially cheaper, assuming your program does it responsibly, than your clients putting it on personal credit cards or, God forbid, the hard money is out there and things like that, to where they are going to hopefully appreciate that, yes, there is a little bit more work, but you're cutting their interest likely in half. I mean, what's credit card interest rate these days? Mid 30s. So
Yeah.
even if the institution is mid to high teens, you're literally cutting their interest in half. You're shaving 20%, 15, 20% off of that. The institution is still finding a new revenue stream, which is fantastic, especially as we know compliance fees and things like that, as this has gotten more competitive, are continuously getting pushed down. So, this is a way that you can offset some of those in a way that's going to bring more people to you. If you stand on the rooftop and say, hey, if you are a long-standing stable operator that is in this area, we want you to come here. We're interested in lending to you. You're going to have a line out the door. I've had a couple of institutions that have already done the math. They've deployed our platform and they're like, yeah, we can actually make substantially more money off of the interest than we ever did off compliance fees. And it's a win for everyone. We're no longer charging compliance fees. We're building out a loan portfolio that's producing substantially more revenue. And we're winning the whole way around because we're now having a line out the door of people that are waiting to get there. And we're able to say, yep, you are a great lending candidate. We'd love to open your account. Or, hey, not at this time. Here's what we can look at. Here's what we can revisit in like 6 or so months or whatever their criteria is for that, because they do have a way to rapidly evaluate that risk now. So I think this is kind of a crazy inflection point as we're seeing this appetite for lending increasing. I think we're going to see it cause a pretty mass shift in how cannabis banking is done, at least at scale. There's always one-offs, and we all know the cousins, best friends, sisters, whatever that knows that mystery place. But other than that, I think at a large scale, this is going to cause a pretty seismic shift.
Absolutely agree, Adam. And you've just actually just pointed out one other uh, uh, mitigation that cannabis lending adds. One thing that financial regulators always want to see is they want to make sure that your financial institution's cannabis banking program overall is financially sustainable
Yep.
and that it's not being subsidized by your non-cannabis members or customers. And by offering the lending, you're again introducing all of this additional now interest income, which is not only making it financially sustainable, but creating greater profitability for your financial institution. So it's not all about taking on more risk. Yes, there is additional risk that needs to be addressed and mitigated, but cannabis lending does offer some mitigation as well.
Absolutely. And a kind of unique way of going about it, because it is allowing you to make that more of a revenue generator, but in a positive way, because it's no one likes fees. Even back in my banking days, whether it was wire fees or transaction fees, all of those things that all businesses pay, not even cannabis businesses, those were always a point of contention. But this is a way that you can offset some of that fee revenue in something that your clients would be ecstatic to pay. If they're paying 15% as opposed to 35, 40%, like think of the actual impact you could have on your clients, which is going to increase their affinity for you. They're going to be substantially loyal. And that's the other thing. I mean, we briefly touched on the rescheduling stuff, but come the end of this month, there's that set of hearings going. We want to make sure that your clients are there today, tomorrow, and regardless of if, in a bizarro world, everything was descheduled. I'm not saying that's going to happen. Dramatic example. We want your clients to stay with you. And if you're charging them a reasonable interest rate, you did that bet on them when it was time, they're not going anywhere.
Yeah.
Now, if you are that, less than above board bank that's charging exorbitant fees and nickel and diming and making their lives hell, they're going to be gone the first second they can. So this also does not only the today risk mitigation, but your long-term financial institutions stability risk mitigation.
Yeah, all great points, Adam. And I see we've already gone over our 45-minute guillotine for our discussion, and we do have some questions. and I want to be respectful of people's time. So I'd like to take a look at some of these questions now and see if we can address some of these. And it looks like we've got an initial one. He looks like he might be a cannabis operator
Mhm.
for cultivating, but we need money and have a brand ready started. So, Don, really good question. We get these questions all the time here. I don't know whether you're already with a financial institution or not. Most of my clients, they are looking for some history before offering any kind of commercial loan to a CRB. Now, having said that, and as I said during our discussion, there are exceptions to that. I don't know what your profile is looking like right now, and whether you have other assets or collateral, and what your credit profile is like. But I'd be more than happy to have a sidebar with you after this if you want to give me a call, and we can discuss that a little bit more. And then let's go on to the next one here, Jeremy Peterson. Okay, it looks like that's much in the same line. Uh, uh, so yeah, this is another really great question, Jeremy. What should I do to preparing to strengthen my request for lending? So, a lot of times the answer you're going to get from a financial institution regarding a request for lending is not no, but when. And so, your question about, your how to strengthen your profile so that you do become a better fit for a lending are all the things that you've mentioned in your in your in your query here. So, and again, Jeremy, if you want to reach out to me, we can talk a little bit more about your specific circumstances, and depending on what they are, I may be able to put you in touch with an FI or a financial institution regarding that. And as usual, we got a great question from Ryan Carlisle. I know Ryan, and he's very astute when it comes to cannabis banking. Uh, so yeah, I mean, I think this is a. I agree with your comment, Ryan. It does seem that it is a sweet spot now, I think, for financial institutions. I think now is the time for any of them to at least be considering cannabis lending so that they're ready if they're not quite ready yet. Um, and again, creating the sticky accounts. Creating a sticky account is a little bit of a double-edged sword, which is why, as Adam said before, you want to be pretty selective, I think, in terms of your cannabis borrower profiles. Uh, I've mentioned this at several other webinars that if things do go south with a cannabis operator on the either on the compliance side with banking or with a state regulator, and they've got a loan, um, that and your BSA officer feels compelled to do a termination filing, that does create kind of an internal conflict within the financial institution in terms of its financial motivation versus its BSA obligations. So good reason, to want to be selective, and for CRBs to, you know, have very, very strong profiles, both financially speaking, but also from a compliance perspective. We've got another one here. Just a second to read this. Okay, Ariane Ma, again, why don't you reach out to me, and my email is right there at the end. If you want to, yeah, if you want to email me, we can perhaps have a discussion. I think it might be useful to find out a little bit more about your profile to see whether or not I can be of assistance. Okay, we're getting
With
lots
you,
of
Chris,
questions.
I'll take that last one.
Yeah, you go for it.
So from Junior, asking if lenders are looking currently at compliance and reputational and legal risk underwriting all in isolation. Currently, yes. And that's what the platform that we released is doing, is bringing all of those aspects together and their interaction. Because any of those in isolation, one, is a terrible way to look at it, but two, doesn't give you the full picture. It doesn't allow you to fully mitigate your risk to the extent you can. And also, it's fascinating to watch how those actually interact and how you can see that if this event happens, then we can predict that in 30, 60, 90 days, we will see these four following waterfall events and how it can cascade and spiral, or conversely, how we can see that these markers mean that this business is positioned to really explode. And so they do become that risk, they do become worth that risk. And so I think that underwriting in general, not just in cannabis, is kind of at a crossroads where they are starting to understand more of those interactions, and that's the entirety of what the new product that we just released, the NCS Thea, does, is help the underwriters better understand those interactions, what that actually means operationally for them, what they need to do to stay inside of their guidance, to mitigate their risk, and all of that. But it's a pretty fascinating time to be a part of seeing how that can actually be done and used.
Yeah. And I just want to add to this comment from Junior because it's a very perceptive comment about
Mhm.
those risks that I identified earlier. And Junior, I would have had those risks as kind of as a Venn diagram that intersected with one another because you're absolutely right. Those risks are not completely separate and distinct. They do interact with each other. So um, it's important, I think, to have structure when you're assessing risk. And I think in order to have structure, you do need to delineate what risks are. But your point is extremely well taken, that the risks aren't the risks that I identified are not mutually exclusive. So great point there. Adam, it's 3 minutes to 12. I can't believe that we managed to finish within the hour. And as usual, we've had great questions from our guests. I do pride myself on being accessible to folks. So if folks want to reach out to me by email after this call, I'll be more than happy to have and we can also have a chat or a call. Please don't be shy about doing that. Adam, I want to thank you again for being part of this conversation. Really, really important. And I think the product that you bring to the table here comes at the right time and is going to be invaluable to many financial institutions.
No, I appreciate you having me back and for helping me out as we were working through all of the fun of Thea. So, and just to reiterate, anyone that has questions, not only about what we're doing, but lending in general, feel free to reach out. Happy to have those conversations. They are a ton of fun for me. So, anyone out there, you've got my email, and I hope to hear from you all.
Yeah. Thank you, everyone. Have a good day.